Okay, so the next thing that we are looking at is the efficiency ratios. So we look at activity or efficiency ratios. Now over here, we are going to look at our efficiency in terms of working capital items, like when we collect our debt from our debtors and when we pay our creditors, the period it takes for both. And then we're also going to look at the inventory turnover period, how long it takes for us to sell a batch of inventory. That is the meaning. Okay, so we are looking at the first formula we are going to look at is the inventory turnover period. Inventory turnover period. And then that one, formula for the inventory turnover period is your average stock or average inventory all over the cost of sales times, we are talking about period. Now, the period, it depends on the period that you have been asked to calculate or the relevant period for the question. It could be in days, it could be in weeks or in months. So if it is in days, we are accounting is supposed to be for a whole year, financial year. So if it is in days, how many days make a year? 365. If it is in months, it's 12 months. If it is in week, it's 52 weeks. So this is going to be times 365 days or 12 months or 52 weeks. So this is how it's going to be, either in days, in months, or in weeks. So your final answer is going to be days, in months, or weeks. So if you have 40 days, it means that it takes, on the average, it takes you 40 days to sell each batch of inventory that comes. That is the meaning. You're talking about how efficient you are. Efficiency. So when you go in for the stock, it takes you 40 days to sell. If you're having 50 days, it means it takes you 50 days. This is very important because by the time we finish with the other two, I'm going to use that to prepare the cash conversion cycle for you, and then you understand very well. So average inventory. What is average inventory? Average inventory is your opening inventory and the closing inventory. You add the two and you divide by 2. So the formula for getting this is opening stock plus closing stock divided by 2. However, in our financial statements for publication, most of the time, because the cost of sales is being given to us as a lump, okay, we do not have the opening inventory in there, but we will have the closing inventory in the statement of financial position. And take note, for examination purposes, if you are not seeing the opening inventory, take your closing inventory as your average inventory and it's acceptable because there is no opening inventory. So you bring that inventory up here over the cost of sales times the number of days or months or years in a year or weeks in the year, and then you get your answer. So that is how to get the inventory turnover period. Okay, so once you have your inventory turnover period, the next item of concern, of course, I'll come back to rate of stock turnover, which is going to be a different formula. That is not going to be in days. That is going to be times. So I'll come there. But let me deal with the days first. So we can also have what we call debt collection period. Debt collection period. Debt collection period. How long it takes for you to be able to retrieve your debt from your debtors. That is the meaning. And so it's going to be, now the first thing you should understand when you are coming to get this formula, how do we even accumulate the debt in the first place? Okay, we accumulate the debt through credit sales, because if you don't sell on credit, nobody owes you. So credit sales is what is bringing about the trade receivables. And so the debt collection period is going to be the receivables itself all over credit sales times 365 days or 12 months or 52 weeks. Receivables over credit sales, that is your trade receivables over your credit sales. So you look at the debt and then the credit sales, and then you multiply, then it tells you how many days it takes for you to be able to retrieve your debt. Now take note of something. You see that the formula has credit sales. It means that credit sales is what you require to calculate this. Unfortunately, the sales that you are going to see on your financial statement, on the income statement, it's not only credit sales, it's total sales. That means that it is a combination of both the cash sales and the credit sales. And there will be no criteria for you to split them into cash and credit so that you come and use the credit to calculate. So for exam purposes, when we get to the exam hall, we are allowed to just use the sales, the total sales here. So it's going to be receivables over sales. However, when you are quoting the formula, please quote this. But you can pick the total sales and then bring it out here because it's acceptable. Let me also emphasize on something. Me, for example, if you are in my class and I'm setting a question, I have a way that I can test your understanding. In a way that if you see the total sales in the income statement and in the additional information somewhere, there is a clause that the organization has a typical characteristics of making 60% of all their sales on credit, then it means that you have to find 60% of the total sales as your credit sales, and then you come and put them in the formula. So when you are given a clue as to the value for credit sales or how to arrive at credit sales, please do and then bring that here. Other than that, pick the total sales and then you bring it. So that is how to arrive at the debt collection period. Let me add the last one and I'm going to interpret them together for you. Then finally we have creditors payment period. Creditors payment period. And just like the debtors collection period, this time we are collecting our money from debtors in the previous one. Over here we are rather paying to creditors. So that one is going to be trade payables instead of receivables. We are going to have payables over. Now, if this place was credit sales, then this place is supposed to be what? Credit purchases. Because it is credit purchases that brings about trade payables when we buy on credit. Now, what we see here is credit purchases. On the face of the financial statement, most of the time, you will not see credit purchases. Even if you see purchases, it will be a combine of credit and cash. Like I told you, if the question is specific enough to tell you the percentages, then you find the credit purchases yourself. If not, then you bring total purchases. But listen, it's even more complex when it comes to company accounts for publication because you will not even see the value of purchases on the question. All you will see on the financial statement is cost of sales. Cost of sales. And inside cost of sales is purchases. And because we cannot identify the exact purchases, this is what we are going to do. When you get to the exam hall, you are allowed to bring cost of sales, the whole of the cost of sales, to replace the credit purchases. So the formula now becomes payables over cost of sales times 100. That is when you don't have purchases and then you don't have the credit purchases. But if you have purchases, please, the formula is not cost of sales. Don't misunderstand me. The formula is credit purchases. But because we cannot find purchases, we bring the cost of sales itself and then we multiply by 365 days or 12 months or 52 weeks because we are working in a year. So that is how to get the creditors payment period as well. Now take note of something. If you calculate your debt collection period, for example, and you have 50 days, then you are supposed to interpret this. It takes 50 days before you can go and collect your debt. So if you sell to someone on credit, on the average, it will take you 50 days before you get your money back. That's the meaning. You don't say, hey, 50 days, then it's too much. Then they are not doing well. Or they are doing well. You don't conclude as to whether they are doing well or not just on the number of days. There is a criteria. Let's also look at this. If your creditors has 60 days, so creditors will give you 60 days before they come for their money on the average. Debtors, it takes 50 days for you to get. Then comparatively is good because you take your money and you have 10 days to spare before you pay. What is bad is that your creditors has given you, let's say, 30 days to pay them back, but you have given your debtors 50 days. Then it's wrong, because it will be your creditors, your debt will be due for payments when you have not also collected from those who bought from you, and you gradually be running out of business because you are going to have liquidity challenges. And so sometimes it's not enough to just interpret them on their own as separate. You have to compare the two of them before you'll be able to interpret. Now, at other times, it will also be about the industry. If in your industry you are getting the debt collection to be 35 days and it takes you 50 days, then you are not doing well. Even if your creditors are giving you 60 days, still you are not doing well in comparison with the industry. You have to also speed up. But there are some industries which are naturally like that. We allow debtors some time, so it could be more. So even if you have 100 days, don't jump into conclusion as to whether it's bad or wrong, it's bad or good on the go. Just look at other factors like the creditors payment, your previous year's financial statement, the industry factors, and all those things will come in before you can conclude whether it's good for the business or it's not good for the business. And you state that in your report. And if they need to improve, you need to talk about how they can improve in the report. So that is how to go about that. So now, let me also use this to teach you about the cash conversion cycle before I come back to talk about the rate of stock turnover. Let's talk about the cash conversion cycle. The cash conversion cycle. Cash conversion cycle. Now, it talks about how long it will take the organization to convert their inventories into cash through sales and then collect their debts, which is from sales on credit, and then get the money to pay off their creditors, all that. So we are going to look at these three to calculate the cash conversion cycle: the inventory turnover period, the debtors collection period, and then the creditors payment period. Now take note that two of them are assets, receivables, and then inventory is relating to assets, and then the creditors are relating to payables, liabilities. And so it is the assets minus the liabilities. So it's going to be your inventory days plus your receivables days, or the debt collection period. You add the two and then you subtract the payable days, or the creditors payment period. That's what we call the payable. So this is the inventory days, receivable days, and then the payable days. So you take that out, and when you subtract that, the final answer you have is your conversion. So let us assume that we have 7 days for inventories, 14 days for receivables, and then we have 10 days for payables. Then it's going to be 21 minus 10, which is going to give us 11 days. So this is what we mean by the cash conversion cycle. So this is the meaning. It means that you see that you have given your creditors 14 days. Sorry. It takes you 7 days to convert your inventory. But the payable days, your creditors are giving you only 10. So you are in shortage of 11 days because you are giving more days than what you are receiving from your creditors. So what is going to happen is that it means you need additional funds from external sources to finance yourself for 11 days. All the time you will be in shortage of funds for 11 days within every period. So you always be required to go to external sources to solicit for funds to help yourself in these 11 days. So this is what we mean by the cash conversion cycle, and it relates to the activity ratios. And have you noticed that all these things still relates to liquidity? Because we are talking about inventory, receivables, and payables. These are working capital items. And so that is it for the activity. But we are not done. I'm going to talk about the stock turnover ratio. Okay, when it's not in days. the inventory turnover period is in days, but the stock turnover ratio is not in days, but it's just similar to the inventory turnover period, just that we are going to turn it upside down, and then we are going to have a different solution on that, and then maybe talk about two more ratios which will give you the formulas by its name, and then we'll be done with the efficiency ratios. Okay, still on the efficiency ratios, let me talk about the rate of stock turnover, which is not in days but is in times. Okay, so you remember that the inventory turnover period, this is the same as rate of inventory turnover, but the period was average stock over cost of sales. But when it comes to the turnover ratio, it becomes cost of sales over average stock. We just turn it around. Okay, so instead of average stock over cost of sales, it's going to be cost of sales all over your average stock or inventory. Okay, and this one is not going to be multiplied by any number of days or months, because we are not looking at it in days. We are looking at how many times. You see, the inventory turnover days talks about how long it will take for you to sell the stock, but the inventory turnover rate talks about the frequency, how many times you bring in new inventory within the year. So you bring the first set within 3 months, you sold it, or you went for another set within 3 months. So if it takes you 3 months as the period for inventory turnover days, then it means that you go for inventory 4 times in a year. So let's assume for the inventory turnover days we calculated, we are using months, and we say the answer is 3 months. Then it means that every 3 months you go in for new inventory because you finish selling it. And for every 3 months, it means that in a year is 12 months, so you go 4 times. So it will make your rate of stock turnover to be 4 times, but your inventory turnover days to be 3 months. So that is the meaning. So that's the difference. One of them is looking at how many times you go, and the other is looking at the number of days or period it will take for you to sell. So here the answer will be times. So whatever answer that you have is going to be times. If you have 10, it's going to be 10 times. That's the meaning. So it means you go for new stock 10 times within the year. So that is how to look at the rate of stock turnover. Okay. Now there are some other ratios like sales to asset ratio. Sales to asset ratio. Now, I don't like writing some of these formulas because the names even suggest the formula. If you see sales to assets, sales over assets, simple. Okay, so those are some of the things that you should just take note of. But basically, the most important aspect of the efficiency ratios is what I have discussed with you so far. And so we are done with the efficiency ratios calculation as well. We are moving on to the last two, which is the gearing and the investor ratio. I know those areas are much technical and confuses a lot of students. Now we move to the gearing ratios. Ratios about debt and gearing. So gearing or leverage ratios. Now these are ratios that measure the quantity or the element of debt in your capital structure. Okay, every company runs with a capital structure. Now this is the meaning of capital structure. It refers to the mix of debt and equity that you are using to run the company. And so if you have more of shareholders fund, let's say you have 70% of the money being contributed by shareholders and 30% as borrowing, then we say that your capital structure is 70% equity and 30% debt. So that is the meaning of capital structure. Now, gearing ratios measure especially the quantity of the debt component in your capital structure, and we use that as a way of assessing your financial position and performance. And so we are going to look at some ratios under gearing that is going to be used to explain the capital structure situation. Now, the first one we want to look at is called debt to equity ratio. Now, another way you can call this is debt to shareholders fund. That is total debt to shareholders fund. Now, when this happens, we just want to look at the relationship between debt and then the equity. So you can say total debt over equity. Equity is shareholders fund. So total equity is to 1. So that the is to 1 will be a representation of the equity. And so let's assume that you have a total capital of $1,800, of which 1,000 is equity and then 800 is debt. Now when this happens, your ratio, this ratio is going to be 800 over 1,000 is to 1, and that is going to give us 0.8 is to 1. So this is how you are going to interpret it. It means that you have 80% of your debt. It means that your debt equals to 80% of the equity. That is the meaning. So 1 represents the equity, and then it means that your total debt represents 80% of the equity. And when we talk about total debt, it is total debt, because there are times where we are going to talk about long-term debt to equity. That is also another ratio, long-term debt to equity. That one, we are going to look at only the long-term debt. When we say total debt, we are looking at both long-term debt and then the short-term debt, which is the current liabilities. So that is the meaning. So it means that you are financing yourself. For every one that you finance yourself with, let's say for every $1 that you finance yourself with, you go and borrow 80 cents also to add up. That is the meaning, making up your capital structure of that. So this is the meaning of debt to equity. Now, if your total debt exceeds the equity, let's assume that you calculated and you have something like 1.2 is to 1. Then it means that your debt has exceeded the equity. It means that you are highly geared. And to be highly geared means that you have too much debt in your capital structure. But over here, we can say that you are the gearing is a little lower because the equity component of your structure is higher than the debt component. In fact, we are going to look at the consequences of high gearing and that of low gearing as we move on and prepare the report. But I'm going to quickly give the second formula. Let us assume that you were asked to find long-term debt to equity. Now, in this case, you've been limited to only the long-term debt, okay? And so you are going to find the component. So it's going to be your long-term debt. And when we talk about the long-term debt, we are talking about all long-term liabilities or non-current liabilities plus your preference shares. Remember that preference shares are long-term debt. So you add that all over your total equity. Okay, so this is how it's going to be. The interpretation is supposed to be the same. Is to 1. And so it means that the is to 1 is there for equity. So if you calculate and you have more than 1, then it means that you have a problem. You may as well use percentages to calculate this. Instead of using is to 1, you can just say this is by 100 and this is by 100. So for the first instance where we had 0.8 is to 1, we would have gotten 80%. It means that your debt, your total debt represents 80% of equity. Okay, that is the meaning. And then the higher the debt, the highly geared you become, the lower the debt, the low geared. Now, high gearing means you pay higher interest rates, and then it is likely that you may have liquidity challenges in the future because the money that you are using to run the business largely does not belong to you. But there is a positive side to high gearing. That is why I said that you may also look at, when you are doing the analysis, you can't completely write off high gearing. It depends on the circumstance. There are a lot of advantages of high gearing. Yeah, one of them is that you pay lower tax according to the static trade-off theory. Okay, so we are going to look at all those things in our analysis. And then let us look at another ratio which we are going to use to do the gearing analysis. And it's very, very, very important. I call it fixed interest cover. Fixed interest cover. This interest cover is a ratio that measures how many times you can pay your fixed interest. And when we talk about fixed interest, we are talking about the interest that is attached to your long-term borrowings. Okay, your debts. And so we are going to look at how many times you can pay from your earnings. or from your profit before interest and tax. How many times you can pay from your profits before interest and tax? Because remember that in company accounts, we have the first profit we arrive at is called profit before interest and tax. And then once we have our profit before interest and tax, then we can take out our interest expense, which is the finance charge. Then we will get the net profit before tax, before we take out our tax expense to get a net profit after tax. Now over here, when you get your net profit before interest and tax, because that is where you are going to pay your interest, okay, so we are going to look at that value, the net profit before interest and tax, and then we compare to the interest expense itself. Then we ask ourselves, how many times can we pay? So if I have a net profit before interest and tax of $1,000 and I have an interest expense of $200, how many times can this 1,000 pay this 500? How many times can this 1,000 pay the 200? You will see that it can pay this 5 times. How did I get that? I divided this by that and we get 5. So it means that net profit before interest and tax can pay the interest expense 5 times. It can cover it 5 times. That is what we call interest cover. How many times can this profit before interest and tax cover the interest expense? That is what we call cover. And so the formula for the fixed interest cover is going to be my net profit before interest and tax. Let me clean this. Before interest and tax over the interest expense. That's the meaning. Over the interest expense. And so I'm going to look at the net profit before interest and tax over the interest expense, and the answer is going to be in times. So if you get 3, it is 3 times. That is how you interpret, you call it. If you get 4, it is 4 times. So that is the fixed interest cover, and it relates to debt because we pay interest from borrowing. That is the fixed interest cover. Net profit before interest and tax over the interest expense, and that is going to give you the number of times this amount of money can pay that amount of money. Okay. And then we can also look at fixed dividend cover. Fixed dividend cover. Now, this fixed dividend that we are talking about, the reason why I'm using the word fixed is because some of these things are not fixed. For example, we have ordinary share dividend, which is not fixed. Okay, fixed dividend has to do with holding shares that comes with a fixed dividend or fixed rate of dividend, and that is where we talk about preference shares. So it's more or less like preference share dividend cover. That is the meaning. So you can call it fixed dividend cover or preference dividend cover. It's the same thing because preference dividends are fixed. You pay the same amount every year. That is the meaning of the fixed dividend. And we are looking at how many times we can cover that. Just like we look at how many times we cover the interest expense. We are going to look at how many times we can also cover or pay the fixed dividend. You remember that I told you that on the format of the income statement, we said that when we get to the net profit before interest and tax, we pay the interest expense. That is why it was used as a yardstick for cover. Now, after the interest expense, we get net profit before tax. Then we pay the tax expense. After the tax expense has been paid, we have net profit after tax. It is the net profit after tax that we are going to use to pay our preference dividend. Then we have our earnings. So once you take out your preference dividend from net profit after tax, the resultant figure is called your earnings, which we are going to look at when we get to the shareholder investment ratios. So now, the yardstick for the fixed dividend cover is that we ask ourselves how many times can the net profit after tax pay the fixed dividends? How many times? And so if my net profit after tax is 400 and my fixed dividend is 100, how many times can this pay? It will pay 4 times. So we divide. And so the same way we are going to quote the formula just like we did for the fixed interest cover. So it's going to be net profit. This time is after tax over the fixed dividend. And in this case, it's the preference dividend we are talking about. So that is it. So you look at how many times the profit after tax can pay your fixed dividend. And that is what we call fixed dividend cover. And we are going to use that also in our analysis. And remember, if you are doing interpretations, I told you that it's either you are comparing with the industry average or you are comparing with your previous year's financial statement. Now, we know that with these covers, the more you can pay, the better. So if I can pay this 10 times and previous years I could pay 7 times, 6 times, and I am improving, it means that I am doing well. Okay, if the industry can pay 10 times and I am paying 11 times, I'm doing better. If I'm paying 8 times, I'm doing worse, or I'm not doing well. Okay, so those ones are just like a mere comparison between your previous year's performances as to whether you are improving in performance in terms of the covers or you are declining in performance. And also you can also look at that with the industry, the average of your industry competitors. How many times can your competitors pay off their fixed dividend? So if they can pay 5 times and you are paying 8 times, then you know what to write. You are doing better. And that you can also even advise. Okay, so that is it with the gearing ratios. Of course, there are some other gearing ratios. But these are what I want to look at for now. You could talk about equity to asset ratio and some other ratios, but these are the basic ones that we need for our analysis. All right, so that will quickly take us to the final category, which is the shareholder investment ratios. And then we are going to look at some ratios there as well before we will start taking questions and then trying to analyze practically our financial statements. Okay, so we'll say shareholder investment ratios. These are ratios that measure the returns to shareholders. Remember that the ultimate goal of shareholders is wealth maximization. They want to maximize their wealth as they invest in the company. And so we are going to use these ratios to analyze how well we are performing towards that goal. Okay, how well we are maximizing shareholders' wealth. Now, there are some key ratios that are used for this analysis. And that is what we are going to focus on. The key ones. And the first one that I'm going to talk about is your earnings per share. Earnings per share. Earnings per share. Very, very important ratio. In fact, this is an accounting standard on its own, IAS 33. And we are going to look at that later into detail. But for now, we are just going to look at the basic earnings per share and the formula for that. And then we are going to use that to analyze our financial statements. Now, earnings per share is usually called EPS. Okay, EPS. And listen, we are looking at shareholders' wealth maximization. And so we want to know how much the shareholders are earning for every share that they have. That is the meaning. Because some shareholders hold, one person can have 10,000 shares in the company, another person can have 5,000 shares. We don't really want to look at the total earnings coming from the shares. The focus is how much are they earning for every single share that they hold as shareholders. And we are talking about the ordinary shareholder. That is why I have already done with the debt holders. We are on ordinary shareholders. Preference shares do not come in here. Okay, so earnings per share, how much do they earn for each share that they have? Now, what is the meaning of earning? We cannot get the earnings per share if we don't know what earnings is all about. Now, earnings, when we say an ordinary shareholder has earned, what is the figure? What is the yardstick? What do we use to measure? Remember that we have to pay our interest, pay our tax, and get net profit after tax. Now, we would have argued, okay, net profit after tax there is for them. But remember that we are yet to pay preference dividend. And so when you have your net profits after tax, you have to pay the dividend for preference shareholders because they are fixed interest earners or fixed dividend earners. So you pay off the dividend of the preference shareholders from the net profit after tax. And the amount that you have after paying off, because you've paid your interest, so you've paid off the debt in that order, You've paid your debt holders their interest. You've paid the revenue authority their tax. Then you come and pay off the interest, or sorry, you come and pay off the dividend of the preference shareholders. Then the money that you have left, you can boast that one you have earned it, because you don't owe anybody. You've paid your interest, you paid your tax, and finally paid your preference dividends. So we are going to say that what we call earnings is our net profit after tax minus the preference dividend, because we've already taken off interest and tax in that profit. And so you can now take out your preference dividend, and the resultant figure is called earnings. And so when we say earnings in accounting or in finance, earnings has to do with your net profit after tax minus your preference dividend. That is your earnings. And so it's going to be net profit after tax minus preference dividend or fixed dividend. This is earnings. Now, we are looking not only at earnings, but we are looking at earnings per share. So if you have been able to ascertain your earnings and you want, this is total earnings. So if you want earnings per share, then you have to divide your earnings over the total number of ordinary shares, and that will be the formula for earnings per share. So earnings per share is your net profit after tax minus preference dividend over total number of ordinary shares that is in the company. So that is the formula for earnings per share. Net profit after tax minus preference dividend, which we call earnings, over the total number of ordinary shares. And we are going to use this. In fact, if you have, let's say, $10 per share as your earnings, and the industry average is $6 per share, then it means that you are giving your shareholders more than what your competitors are giving on the average. And you are doing very well. You are justifying the reason why they had to invest in your company and not in your competitors, and you are doing well for them, and that is going to attract more shareholders. People will start running to buy your shares as a company, and you grow. Your share price will go up, and that means that the value of the company is going to go up. All these things that I am mentioning are things that you have to most of the time mention in your analysis. Okay, so for example, if you have a lower earnings per share than the industry average, then it means that your competitors are doing better. And that is also a warning for you, that if you are not careful, people will start running to your competitors to invest because they believe they are going to earn better on those sides. And you can also compare with your previous year's statement to see whether you are improving in terms of the earnings per share for shareholders or you are declining. So that is it. We all know that when it comes to earnings, everybody wants to earn more. So the higher, the better. But it is not just about comparing with yourself. You have to also focus on your industry to see. It could be that for that particular industry, that is the average earning. And so if you are earning around the average, fair enough. If you are doing better, excellent. If you are not doing up to the standard of the industry average, then there is a problem. And that is where you have to do proper analysis, advise the company, and then talk about all these things that I'm talking about. But we are going to look at a practical question. So now that we know about our earnings per share, let us come and talk about dividend per share. Dividend per share. Now, a lot of people confuse earnings and dividend as if they are the same. They are not the same. What the shareholder is earning is different from the dividend that he is receiving. Remember that the shareholder may be earning 10 cedis per share, but will be taking only 3 cedis per share as dividend. The extra 7 that is left will be retained in the business for expansion. In most of the time in company accounts, we don't pay all earnings to shareholders. We pay part as dividend, then we retain a part. That is why we call something retained earnings, which we call the income surplus as well. You see, that is where the name came from, retained earnings. The earnings is true that you have earned, but we not pay all to you at the end of the year. We retain some for expansion purposes and for doing proper business, and then we pay you a part. So we know that, yes, that is why retained earning is still part of the equity, because it's still for the shareholders. It's the earnings that has been left inside the business for expansion. And it is the board of directors that decide what percentage to pay out, and then what to retain. So we can even look at dividend payout ratio as well. Okay, so dividend per share, we are looking at the proportion of the earnings that is being paid to the shareholders as dividend. And so the board of directors will usually propose a total amount of dividend to pay for all the shareholders. Sometimes you have dividend proposed, dividend paid, whether proposed or paid or a combination of them. Once the dividend relates to that whole accounting year, it is accepted as a dividend for the year. Whether part has been paid or not, we add it up because of the accrual concept. And so the total dividend that is proposed and paid, then we have to divide it by the total number of ordinary shares to know the dividend per share. So dividend per share is the total dividend, which is in monetary form, dividend proposed and paid, all over the total number of ordinary shares or equity shares. So it's going to give us the dividend per share. So this is how we come about dividend per share, which is quite different from the earnings per share. We are earning, so you see, it is always expected that the earnings per share will be a higher amount as compared to the dividend per share. So if you are earning $10,000 in total, and then your total number of ordinary shares is 100,000 shares, then you are going to have $0.1 per share as your earnings per share. That is the meaning. You are going to have 10 cents or $0.1 as your earnings per share. Now, if you are proposing out of this 10,000 earnings, if you are proposing a dividend of, let's say, $6,000, that you are not, you are retaining you are retaining 4,000 and you are paying out 6,000, all over the same number of ordinary shares of 100,000, then it's going to give you dividend per share of 0.06 per share. That is the meaning. So you see that the earnings per share is always expected to be higher than the dividend per share. However, if you have it the other way around, then there should be a question to answer. If you calculate and you realize that your dividend per share is higher than your earnings per share, please look at it again. And if you think you are sure of your calculations, then there is something wrong with the company, because you are paying dividend more than what you have earned. It means that you are still paying from the previous year's retained earnings, and that could also spell a problem, or there should be something to talk about in your analysis. So you see, most of the time, I tell you, or I tell my professional students especially, that when you are doing this kind of analysis, they will always make sure there is a problem to tackle in the question. Most of the time, the question is set in such a way that one way or the other, there should be a problem somewhere, which you talk about in your analysis. Okay, so make sure that you are very smart in some of these things so that you know what to say in your analysis in order to fetch you marks. Because at that level, you are not in an office where you are doing a practical analysis. It's in an exam hall. You are trying to do analysis for the examiner to mark. And let me also say this. Avoid using absolute statements that you are not sure of or that the question has not mentioned. Sometimes you may just use the expression may or might. It might be that this and this and this is happening, or it may be that they are doing this in the company, or it may be as a result of. You see, once you use the word may or might, it means that you are not too sure, but you are only expressing your knowledge as a business person, okay, or as a finance person in this matter. But when you are sure and you make a statement like, this is because this and that happened, or this and this is what they are doing, then it means that you have been able to detect that from the financial statement and you are talking about it. Of course, when you see it clearly, you have to talk about it clearly. But when it is not there, but you are guessing it may be a problem like that, even though it's not clear, then you know the language to use in your analysis or in your presentation of the report or the comments you are making under the ratios. So please, let us be mindful of some of these comments that we make, because that is what is going to fetch us mark or not. All right. Okay, so the next ratio that we'll talk about is the earnings yield. The earnings yield. Earnings yield. And the earnings yield has to do with how much the price, the market price of the share is yielding in terms of earning. Okay, and so that becomes your earnings per share over the market price per share. That becomes your earnings per share over the market price per share. And so if you get the calculation of your earnings per share wrong, it means that you are going to get the earnings yield also wrong, because the value that you get from here is what you are going to put here. And we are looking at you can multiply this by 100 if you want, because the interpretation is done in terms of percentages. Okay, if the market price per share is, let's say, $5 per share, and then the earnings per share is $2 per share, then it means that this is 0.4, or you can say 40%. Now, it means that for the price that I buy the share, if I'm a shareholder and I bought the share, or the current market price of the share that I'm buying it for is $5, then it means that it's going to give me 40% as a return on it every year. That is the meaning. So every year I'm going to get 40% of the price of the share as my return on the share every year. That is the meaning of the earnings yield. How much is it going to yield? How much is it going to yield for me? The price that I'm buying the share, how much is it going to yield? And some of these things, especially with the shareholder investment ratios, the higher the better, because as for the shareholders, they're interested in wealth maximization. So you compare with the industry average, you look for the higher to be the best. You compare with your previous year's financial statement and your ratios like this in the previous year, and then you can make objective analysis as to whether you are doing well or not in terms of the earnings yield. So that is it with the earnings yield. Now, let me quickly bring in a ratio that is very similar to the earnings yield, okay, so that we will use it quickly to understand. And that is called the price earnings ratio. The price earnings, which we call the PE ratio. Price earnings ratio. They call it the PE ratio. Now, this one, the name even will suggest price/earnings ratio is price over earnings. So you see what we are going to do is that it's just a turnaround of the earnings yield. The earnings yield is earnings over price. The price earning is price over earnings. So it's going to be market price of shares per share, this time over the earnings per share. Okay, that is why I brought it just exactly after that, so that you will not be confused. The earnings yield is earnings per share over market price per share, but the price earnings ratio is the market price per share rather over the earnings per share. And it's just an opposite way. And you see, in this case, if you are using the same figures over here, it's going to be $5 over 2, and that is going to give us 2.5. Now, this is the meaning. It means that, you see, remember that with the earnings yield, I interpreted it that for every year, I'm going to get 40% of the value I am investing in the price. So if I am getting 40% this year, next year I'm getting 40%, then I have recovered 80%, but I want to recover 100%. And you know, in every investment, before you can say you are making profit, you would want to recover the cost of your investment, or the initial cost of the investment, so that any income that comes after the initial cost has been recovered is termed as profit. That is what we do in investment appraisal. Now, in the same way, if I am buying $5 per share as a price, and I am earning 2 in the first year, which is 40%. Second year, I'm earning 2, which is another 40%, which makes 80%. In the third year, if I earn additional 2, I've earned 6. It means that I'll recover the initial price in the third year, but at the end of the third year, I would have recovered and even gotten an extra profit of 1, because 2 times 3 years is going to be 6. So it means that it will take me 2.5 years to recover this price of $5. And that is what the price earning ratio seeks to measure. 2.5. That is what we have gotten. So in other words, it will take the shareholder 2.5 years to recover the price, the value of the price. It will take the shareholder 2.5 years to recover the amount that he put into it in terms of investment. That is the meaning of the price earning ratio. So the price earning ratio, the interpretation is about the number of years. So this is years that you are going to use to interpret. So if you are getting a PE ratio of 2.5 and your competitors are getting PE ratio of 1.5, or let's say yes 1.5, it means that rationally every shareholder will move to your competitor, because when it comes to investment, we all want to recoup or recover the initial cost of our investment quickly and then start making profit. So if it's going to take me 2.5 years to recover, and another competitor, it will take the person 1.5 years to recover, then it means that rationally every investor will move to the other company. So this is a very important ratio in terms of it is more like a tool for investment appraisal, the PE ratio. And then the earnings yield also, it's just that they come in an opposite way. The earnings yield talk about the percentage you are getting every year, but the same percentage will tell you how many years it will take to recover your initial investment in terms of the price of the share that you bought on the stock exchange market. Okay, so the market price of the share over your earnings per share will give you the number of years it will take for you to recover your initial investment in the organization. And then if you are comparing with your previous years, then of course we know that you look at the trend as to whether you are improving in terms of reducing the years, because everyone wants a shorter year. So it means that the shorter the period, the better. It's like the payback period. Okay, the shorter the better. So that is how to interpret the price earnings ratio. Okay, I'm sure we are okay on that. Okay, now one more thing to look at. Since we've looked at the earnings yield, let us also look at dividend yield, because we looked at earnings per share and we look at dividend per share. So earnings yield, let us also look at the dividend yield. Now dividend yield is just the same as the earnings yield. That the formula is the same, just that we will change the earnings per share to dividend per share. Everything remains the same. We are the denominator is still the market price of the share. So let us look at dividend yield. Dividend yield, and that is going to be dividend per share over market price per share times 100. You will see that here we look at the percentage of the price of the share that is coming to you as dividend. Over here is the percentage that is coming to you as earnings for a year. Then we look at the percentage that is coming as dividend per year. Okay. Of course, you could also look at price dividend ratio, just like we have price earning ratio, which is going to be market price over dividend. And that is going to give you the number of years. But it's not an ideal ratio, so we don't really talk about that, because the focus is on earnings when it comes to shareholders' investment recovery. Okay, so this is just to tell you the percentage of your investment or the market price of the share that is going to come back to you as dividend every year. And it's also a tool to make a decision as an investor. In fact, these ratios are very important, because if an investor or someone wants to come and buy shares in your company, these are the ratios that they look at. These are the indicators that is going to inform them about your performance as a company, whether you are doing well for shareholders or you are not doing well for shareholders. And so that is very, very important. These are very important ratios that we should take note of. Okay, so that is it for dividend yield. So let us look at two more formulas relating to the shareholder investment, and then let's see what next to do. So let's look at the dividend cover, ordinary dividend cover. I've already spoken about the fixed dividend cover, which relates to the debt, the gearing. This is the ordinary dividend cover. We are looking at the dividend cover just like we did in the previous ones for the fixed dividend. And that is going to be our earnings per share over dividend per share. and that is also going to be given to us in times. Remember that all the covers, we want to look at how many times our earnings can cover the dividend, for example. So over here, if this will become more complex for you, you can just say earnings over dividend. Simple. It's as simple as that. It could be your earnings over your dividend, or earnings per share over dividend per share. In which case, earnings is net profit after tax minus ordinary dividend. Okay, and then the dividend per share, we know how to calculate that. And so, for simplicity's sake, you master this formula, you calculate your earnings per share, you calculate your dividend per share, and then the earnings per share over the dividend per share is going to give you the number of times. So if it is 2, it will be 2 times. If it's 3 times. So it's going to give you the number of times that your earnings can pay your dividend. That is the meaning, because we said that when we get the earnings, we pay out dividend and we retain part of the earnings. So that is the dividend cover for you. Okay, and then finally, let us look at the dividend payout ratio. The dividend payout ratio. The dividend payout ratio. Now, you see, that is also going to be a turnaround. That is going to be the dividend per share over earnings per share times 100. Very, very important. We want to look at what is the percentage of earnings that we pay out. And I mentioned that earlier. So if I am making earnings of 1,000 and I am paying total dividend of 700, then of course, it means that my dividend payout ratio is 70%. It means that for every 1,000 that I earn, I pay out 700. So that is 7%. So dividend payout ratio, you can say your dividend itself over earnings times 100. Or you can say dividend per share over earnings per share times 100. So whichever way that you want to go, it depends on the information that you have at your disposal. So the dividend payout ratio is about the ratio of dividends to earnings. How much are we earning and how much are we paying? So we earn 10,000 as net profit after tax minus preference dividend. That is our earning. Then we decide to pay a total of $5,000 to shareholders. Then it means that the dividend payout ratio is 50%. And shareholders may also need that information, because it's not all the shareholders who just want their money to be always be reinvested in the business all the time. Some of them are interested in the amount they are taking home as dividend every year. That is most of the time the motive of the shareholders, even though they want to increase their wealth in terms of the price and the value of the business. But they would also want to take away something in terms of dividend. And so the dividend payout ratio will be in percentage. So in this case, it's going to be times 100, and that is going to give us 70%. So it means that for every earning that we make, we pay a total 70% out. It also means that we are going to retain 30%. So retained earnings is always 30% of earnings. That is the retained earnings that we are going to add up to expand the business to our equity. 30% of earnings, because we are paying out 70% of earnings. So this is what the dividend payout ratio is all about. In analyzing the dividend payout ratio, for example, your analysis, you should be careful, because the expectations of shareholders is different from the expectation of the board. That is why there is an agency problem always when it comes to this kind of analysis. There is an agency problem in management of other people's resources, because the board would want to keep more of the funds in the business for expansion so that they can do better in terms of performance. Shareholders also want their dividend to be paid to them. So there is a conflict of interest. So in your analysis, you have to be careful and talk about some of these things. Of course, when you have a higher dividend ratio, payout ratio, it's going to attract people to come and invest. But your competitors may have a lower one, and they will have an advantage of expanding and later taking over you in terms of competition. And so you have to look at both sides in your analysis. You don't just jump into conclusion and say this person is doing well and this is not. Okay, so I always tell you that this is analysis. Nobody tells you what to write. Just understand the ratio, write what you understand. But make sure that your analysis is making sense. okay, so that at least we can make some meaning out of what you are saying for business policy decisions. Okay, so that is it for what I want to talk about in terms of the shareholder investment ratio. Like I always tell you, for all the categories of ratio, there may be some other ratios that I have not mentioned. I know they are, but these are the key ones that are important for what we are doing and for what we are going to do. And so just master these ratios, get question and start solving. In our next video, we are going to solve a question involving these ratios and learn how to make comments on them. And then again, we are also going to look at a question that involves report writing, and then we are going to look at the format of the report and then how to write the report and what to avoid in writing the report in terms of the interpretation of financial statements. So continue following, subscribe to the channel if you are new, share this video, let others also have a benefit. Let us all be successful together. Until we meet again next time, it is bye for now. Thank you.